Cold open. A stunning day on Wall Street. The S&P 500 charging higher, Moderna's stock soaring after a major cancer treatment breakthrough, targets earnings doubling, and a chip sector split between giant gains and steep losses. Plus Treasury yields holding at 5% are creating winners and losers across the dividend world. Good afternoon. I'm your host, and this is your market news briefing for Tuesday, August 19th, 2026. Transition, Moderna's mRNA cancer breakthrough. Let's lead with the biggest story of the day. Moderna shares surged after the company announced its experimental mRNA cancer treatment passed a key clinical trial, meeting the primary endpoint. According to the Associated Press, the results represent a significant milestone for the mRNA oncology pipeline. And Moderna is not alone in this space. Merck also reported that its melanoma vaccine met the primary endpoint in its own trial. That gave us a rare moment where two major pharma names were in the news simultaneously for advancing cancer vaccines built on mRNA technology. The headline ran across the midday news, Moderna, Merck both hitting trial milestones. Investors responded with enthusiasm, and the biotech sector got a substantial lift. This matters not just for Moderna, ticker mRNA, but for the entire mRNA platform, which has shown potential far beyond infectious diseases. If these results hold up, the door opens wider for mRNA treatments targeting a range of cancers. Transition, retail earnings, Target delivers, Lowe warns. Speaking of earnings, let's talk retail. Target is arguably the standout story in the consumer space right now. The company reported Q2 earnings that doubled year over year, and, key detail here, tariff refunds provided a meaningful tailwind. Target raised its full-year outlook as a result. The stock jumped to fresh highs. That is a significant data point because it suggests that despite the headwinds many retailers have talked about, tariffs, consumer pressure, Target found a way to come out ahead. It also caught the attention of analysts. CFRA Research put out a note on Walmart noting that if Walmart does not raise its own outlook, the stock could fall. So Target versus Walmart is shaping up as the two retail heavyweight comparison for this quarter. Now let us contrast that with Lowe's. During the Lowe's Q2 earnings call, the CEO explicitly cited caution around consumer spending pressures. There is a real divergence here. Target is thriving with doubled earnings and an upgraded outlook, while Lowe's management sees consumer spending tightening. It underscores how uneven the retail landscape is today. If you look at peers, TJX and Costco showed strength, but the message from Lowe's adds nuance to the broader retail picture. Even Home Depot, which had a sales outlook improve according to RBC, faces lingering cost pressures. And BofA Securities recently trimmed its price target on HD from 412 to 407, though it maintained a buy rating. The take here is clear: retail is not uniform. Pick the right company and you see growth. Pick another and you see caution. Transition, semiconductors, AI glimmer vs. broader sell-off. Now to the semiconductor sector, where the story is deeply divided. On the bright side, Marvell Technologies jumped 12% on news of a major new AI chip deal with Google. Google received a warrant giving it the right to buy a stake worth approximately $12.2 billion in Marvell stock. The deal was widely covered by Barron's and Guru Focus. It is a massive commitment and it sent Marvell soaring. This is the type of news that feeds directly into the broader narrative about artificial intelligence infrastructure spending remaining strong. And it is not just Marvell. Analog Devices also guided for an above-consensus Q4, citing robust chip demand. Jensen Huang, NVIDIA CEO, saw his net worth climb $28 billion this year, a reminder that despite recent turbulence, the AI value chain is still generating enormous wealth at its top. But there is a counter-narrative. Intel and AMD both fell roughly 4% in a broader chip sell-off that, notably, defied relief from falling bond yields. NVIDIA itself was flat despite a 2.34% decline on heavy volume of more than 103 million shares. Intel, trading at 96.69, was one of the highest volume names on the market, moving nearly 122 million shares on the day, and it fell 6.6%. That is a lot of volume on a down day. Still, there has been a silver lining for Intel believers. Insiders have been buying the stock, and a veteran fund manager was heard rethinking Intel's stock target. There is also a story from the street about a fund manager reconsidering Intel's outlook. So on one hand, you have the sell-off, the volume, the 4% drops across multiple chip names. On the other, insiders are buying, and one company, Analog Devices, is guiding sharply above consensus. The chip trade right now is a tale of two narratives, and the market seems to be trying to figure out which one wins. Transition, dividend stress test, and fixed income. Let's shift gears to the income side of the market, where Treasury yields hovering near 5% are creating the stress test for dividend investors. Multiple pieces of analysis today revolved around which dividend stocks can actually withstand a 5% Treasury environment and which cannot. The headline framing was blunt: the 5% Treasury is exposing every fake dividend stock. Among the names that were flagged as genuine dividend growers, the ones that can arguably survive, were Realty Income O, MetLife MET, Vornado Realty Trust VNO, and Verizon VZ. By contrast, names like Kraft Heinz KHC, Altria MO, and Dow were called out as the kind of stocks that do not belong in a portfolio when risk-free rates offer 5%. For investors looking at dividend income, this is a really important theme. The analysis suggests that the old play of simply buying high-yield stocks is no longer sufficient when you can park money in treasuries and get 5% without any counterparty risk. There is also a specific play that caught attention: Fidelity's answer to the popular JEPI ETF. The new Fidelity product charges less, pays an 8.2% yield, and, according to the analysis, actually doubled JEPI return this year. That is noteworthy. For income-focused investors who have been rotating between JEPI and its competitors, this is a new variable to factor in. And we also had a deep dive on mortgage rate. 3 monthly paying mortgage rate, including ARR, DNTRDX, and ORC, along with FNMA-related names, were highlighted as income investors keep coming back to. These are all plays tied directly to the mortgage and rates environment, which brings me to the real pain point for a lot of everyday Americans: transition, mortgages, small caps, and macro crosswinds. The Fed has held interest rates flat for 231 days now. But mortgage rates went up anyway. That disconnect has real consequences. The analysis pointed to its impact on homebuilders like DHI, financial firms like PNC, and rocket companies RKT, and mortgage rate like NLY. The mismatch between flat Fed policy and rising mortgage rates is a reminder that mortgage rates are not simply a function of what the Fed does at its next meeting. They are more deeply tied to the bond market, to inflation expectations, and to the longer end of the yield curve. And the Treasury Department lifted its buyback cap on long-dated securities today, which could add supply to an already tense long-end market. All of this reinforces why mortgage rate investors are closely watching every move. On the equity side, there was a sobering piece about the small cap premium. For decades, investors believed that small cap stocks, typically measured by the Russell 2000, ticker IWM, would, over time, outperform large cap indexes like the S&P 500, represented by VOO. That supposed premium has not materialized over the past 15 years. The data shows a persistent gap of underperformance by small caps. It is a long-term structural story, not a quick trade, but it complicates the bullish case that many retail investors have made about small caps finally breaking out. And one more macro note: Bitcoin remains on the radar. The question on many tables is whether Bitcoin can get back to $100,000 in 2026, and analysts say a great deal hinges on this year's outcome. BTC/USD was referenced alongside NVDA in multiple pieces, suggesting the crypto market and tech market narratives are increasingly intertwined. Transition, market movers, and technical signals. Let's check the tape. The most active names on volume today included Nvidia with 103 million shares, Intel with nearly 122 million, Nokia with 112 million, and Tesla's TSLL with 123 million shares trading relatively flat. Among big movers in microcap land, SIS gapped up more than 4,500%, PFSA surged over 500%, XOS jumped 112%, and CAST leaped 144% on massive volume, 154 million shares. On the other side, BCPC collapsed 87%, CTG dropped 41%, and LGCL fell more than 82% on huge volume. These are mostly sub-$5 names with extreme moves. The technical signal scan across 10,802 symbols produced 9,728 total signals, 15 bullish and 35 bearish. The top bullish reads showed strong momentum on MIS, MBI, Zasawa, and WOW, and XHG. But notably, two of those same names, and WOW and XHG, also appeared on the bearish side flagged for potential overextension. OFL, SDKH, and EAL were marked overbought. So the system is flagging a good number of names that have run hard and may be due for a cool-off. If you trade in this kind of space, it is worth paying attention. Transition, tech, AI, and the big tech rundown. A few final items from the mega-cap space. Microsoft was featured in a piece predicting that its AI boom is bigger than investors realize. Alphabet's AI spending push came with a discussion about the price tag. Both Google and Goog were referenced as costs continue to climb. Meanwhile, Meta's $1.4 trillion legal risk took a new turn, which, if you have been following Meta, is not a small story. And Apple had a curious sidebar today. Steve Jobs' 8th grade science fair project drew $8,475 in bids at a memorabilia auction. It is a small data point, but it reminds you how the culture around these tech companies has become part of the broader investment narrative. And one more note on the income side, Procter & Gamble's market share trends are improving according to RBC, and it was highlighted as a wide moat dividend king that investors are advised to hold forever. It is one of those steady name mentions that shows up when the market wants to retreat to quality. Sign off. So here is the takeaway for August 19th, 2026. The market is navigating a lot of moving parts. Moderna and Merck are lighting a flame for mRNA oncology. Target is crushing it while Lowe sees caution. Semiconductors are split between AI-fueled gains and broader sell-offs. Dividend investors are getting a reality check from 5% Treasury yields. And if you are in microcaps, the volatility is off the charts. The S&P 500 closed higher today heading into FOMC minutes, and that sets the stage for what could be another busy week. Thanks for listening. I will see you tomorrow for your market news briefing. Until then, stay informed.